Hello, this is eshing1 of BCS. Today we're going to look at 4 ways to get exposure to the bond rally. We're going to look at Eurozone deflation. Remember, inflation is only at 0.5% in the Eurozone. There are 4 basic ways that we can see that you can play lower bond yields. Firstly, let's look at the German bond. Here we have the German Bund future for the 10-year. You can see that over the last 20 odd years it has been in a bull market ever since reunification and has actually broken out of the top of the bull channel here. Switching to a weekly chart of the same Bund future, we can see again the same uptrend, and we can see that it's trying to break out of this red line level 3 times. It's now there for the 4th time. I think it'll break out to the upside, which suggests further gains ahead for bond prices in Germany. If we look at the UK 10-year bond yield, we can see as well that the bond yield has been going down, that the downtrend in yields and therefore the uptrend in prices in the UK is also still in place. And this is also true if we look here on page 6 at US Treasury futures. Yes, there's been a big correction since 2012 and 2013, but this long-term uptrend in bond prices in the US is still intact, suggesting we are going to continue to move higher going forwards. Implied inflation rates, looking at the difference between long-term bond yields and inflation-protected bonds, has been going down over the last year and a half, is now 2.6% in the US. This is the same in Europe. Here in France, we can see that this implied inflation rate, looking at the difference between nominal bonds and inflation-protected bonds, suggests long-term inflation is only 1.4% now. So it has been coming down, which is bullish for bonds. Here on page 9, we can see that US analysts have been wrong in forecasting higher Treasury yields. At the beginning of the year, they were forecasting only 3.2% 10-year Treasury yields, and in fact, the actual number is now 2.5%. So instead of yields going up, they've actually gone down this year, and consensus has been wrong. And we think they will continue to be wrong. 4 ways that you can play this lower bond yield, higher bond price trend. Firstly, Build America bonds. BlackRock have a closed-end fund which yields 7.2%. And you can see this green line is the 30-year US Treasury yield. And as that goes down, which in this case you can see is an inverted scale, so as the green line goes up, these are yields going down. The black line, which is the BlackRock fund, does very nicely. Same story here on page 12 with mortgage real estate investment trusts. You can buy an ETF called MORT, which yields 8.7%. The story is the same. As long-term Treasury yields decline, the mortgage REITs do very well. Third idea is the utilities sector. Again here, XLU, the utility sector ETF in black, does very well as bond yields decline. And lastly, emerging market sovereign bonds. As 30-year Treasury yields decline, this black line, which is emerging market bonds versus high yield bonds, goes in favour of emerging market bonds. So we still like emerging market bonds, and they should perform very well as US yields decline. To summarise, 4 ways to play lower bond yields. Build America bonds, 7.2% yield. Secondly, the mortgage real estate investment trusts, 8.7% yield. The American utility sector, 3.4% yield. And emerging market sovereign bonds via the Morgan Stanley Emerging Markets Domestic Debt Fund, which yields 7.5% and trades at a 13% discount to net asset value. These are 4 high-yield ways to play the current bond rally. This is eshing saying thank you for listening and goodbye.